Welcome to This Explainer. Today, we're unpacking a strategy that sounds totally backwards at first glance, but is actually brilliant. We're going to look at exactly how a legacy brick-and-mortar retailer transformed into a modern financial powerhouse. And they did this right when the headlines were practically screaming that traditional retail was completely dead.
Look, we've all heard the doom and gloom, right? The narrative that the only way to survive the so-called retail apocalypse is by either going 100% digital or building these massive megastores. But Burlington, they did something wildly different. They swim in the complete opposite direction. And honestly, the results they've seen by defying the entire industry have been absolutely spectacular.
55%. That is the magic number we are reverse engineering today. It's a staggering leap in sales productivity since 2019, and it's the absolute engine behind their financial success right now. Literally every single operational and merchandising decision we're about to dive into was obsessively designed to push this one specific metric through the roof.
To put that into perspective, just look at the stark contrast between the old, kind of bloated Burlington of 2019 and the hyper-efficient machine they run today. In retail, your sales per selling square foot, that's your ultimate pulse check. It tells you exactly how hard your real estate is working. Languishing around $220 is just pure survival mode. But hitting $350, now you're squeezing vastly more cash out of significantly less physical space. It's a complete paradigm shift.
So, let's get into Act 1, the shrink to grow strategy.
Now, how exactly do you pull off a 55% leap? Well, it starts with a super disciplined surgical approach to real estate. They didn't just blindly shut down stores. Instead, they hit it from three angles: actively downsizing older locations with way too much wasted space, relocating others into premium, high-traffic centers, and totally renovating existing spots to make sure every single square inch is pulling its weight.
You see, getting smaller isn't a retreat. Actually, scratch that, it's an absolute financial weapon. CEO Michael O'Sullivan pointed out that by cutting square footage in half, they strip out about 200 basis points in occupancy costs. For any physical business, lifting that massive permanent weight off your profit and loss statement is huge. It means all those top-line sales just flow straight to the bottom line without getting chewed up by rent and utilities.
And these new, nimble 25,000 square foot boxes, they are incredibly capital efficient. They're cranking out around $7 million in first-year sales, meaning they completely pay for themselves in under 2 years. If you know retail, you know a payback timeline like that is basically unheard of. Plus, just moving an old, oversized store into this smaller format instantly triggers a 5 to 10% sales lift. So they're spending way less to build them and making more money the second the doors open.
Moving right along to Act 2. Upgrading the shopping experience.
Because let's be real, shrinking a store only works if people actually want to go inside, right? Burlington is actively shedding that 1970s coat factory vibe. You know, the chaotic sea of racks they used to be known for. Their store experience 2.0 is way brighter, much easier to navigate, and it really leans into that off-price treasure hunt feeling that shoppers absolutely love. The whole environment is purpose-built to support that 55% productivity goal.
Just wrap your head around the sheer logistical scale here. 80%. By the end of 2028, over 80% of their 1,500-plus stores will be brand new, relocated, or completely downsized compared to 2019. They are essentially replacing an entire national physical fleet in less than 10 years, flipping an aging liability into a total powerhouse asset. Which brings us to Act 3, smarter inventory, better margins. You can't boost productivity by 55% just by moving walls. You have to put the exact right stuff on the shelves. And they've completely modernized how they flow goods. Here's the wild part. They hold a massive 41% of their inventory in reserve. That's a huge strategic advantage because they don't have to flood these new, smaller stores with excess product. They can just sit back, watch micro trends or weather patterns develop, and drop the merchandise exactly where it's going to sell the fastest. This kind of ironclad discipline acts like a shield for one of the most critical metrics in retail: merchant margin. By keeping such a tight grip on inventory, they flip products way faster and totally avoid those desperate, margin-crushing markdowns you see at traditional department stores. Even with crazy macroeconomic pressures going on, like fuel spikes or tariffs, they hold the line, keep more gross profit from every item, and just keep driving that productivity higher and higher. And finally, Act 4, the financial payoff. Okay, so what happens when you throw all of this together? The highly efficient 25,000 square foot boxes, the massive real estate savings, the strict inventory control. Boom, you get an absolute bottom line juggernaut. 14 consecutive quarters of double-digit earnings per share growth. That proves they aren't just bumping up top-line sales, they're turning those sales into explosive earnings because their baseline costs are just fundamentally lower. Just look at the leverage going on right here. In the first quarter of 2026, their comparable store sales grew a solid 6%, sure, but their earnings per share rocketed up by 26%. That insane leverage is exactly what you get when you boost your sales per square foot by 55%. Literally, every extra dollar coming through those doors works exponentially harder for the entire business. And Wall Street? Oh, they absolutely love this shrink-to-grow playbook. I mean, look at this insanely bullish consensus, 0 sell ratings. The street clearly has massive confidence that this leaner, meaner version of Burlington is just going to keep bleeding market share away from those bloated traditional department stores. It's a huge flashing sign that this optimized model is the new gold standard in retail. So this leaves us with a really fascinating dynamic. In a landscape that's totally obsessed with digital scale, a physical discounter engineered a 55% productivity jump simply by proving that less square footage equals far more profit. As we wrap things up today, ask yourself, if a 1970s coat factory can reinvent itself into a hyper-efficient machine just by optimizing space and inventory, who's going to be forced to adopt this playbook next? Thanks for tuning into this explainer. We'll see you next time.